Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented by Tusk Media. Real quick, give us a follow on Twitter, twitter.com/TuskMediaLLC. We're at the same kind of end of the URL on Facebook, facebook.com/TuskMediaLLC. Same place on YouTube, youtube.com/TuskMediaLLC. I'm Andrew Hall. Joining me today is Ben Nye, and today we're going to be continuing to look at some bank stocks. We're looking at Wells Fargo right now. So Ben, how you doing?
I'm doing well.
Doing a little bit better than Wells Fargo's quarter, maybe?
Yeah. At least I'm not trying to hide a bad quarter.
Exactly. So overall impressions, and maybe we tipped our hand a little bit there, and maybe not a huge surprise because earnings were released a couple days ago, I guess last week, but not the greatest quarter from Wells. We've been looking at J.P. Morgan, also Citi. Where would you kind of rank Wells Fargo relative to those two peers?
I'd say Wells Fargo at the bottom. They did post a good beat on the EPS, but that was juiced by a lower tax rate, net interest margin that actually was slightly better than expected, whereas Citi and J.P. Morgan were hit by that, and insurance sales. And the loan growth was relatively weak. The auto business, we'll talk about, it's a managed decline right now because they're nervous about the risks there. And in general, it's just a long pathway to getting over this account scandal. And it's going to take some time. And for that reason, you're seeing this underperformance. What I would say is the positive is that their CCAR results did pass with no conditions attached. And that's a positive because it does show that although they're making slow progress on improving the efficiency, they are still checking the boxes, and they're making sure that they're a well-run company, and that's the number one priority for them.
Yeah, and it's really interesting. I mean, we've been talking about the account scandal for going on almost a year now. It's really interesting how that just kind of continues to build this hole, and it's easy to look at something like that. I think in real time, this probably applies to any company going through kind of a big headline scandal. It's easy to look at that in real time and say, oh, well, this sell-off was unfair, it was too deep, that kind of thing. But then you start to see in real time how long it takes to kind of pull yourself out from under that. There's some strength in terms of how they're doing things, and they're trying to be a well-run company. They're making efforts to do that, but it's a process, and it's kind of a grind getting back there, especially when you have really some challenges on kind of the lending business.
Yeah.
So what did we see there, as it relates to autos as well as kind of the mortgage business for Wells?
Yeah, so on autos, they are getting concerned not so much with what used vehicles are selling for today, but they are concerned with the high percentage of leasing in the auto business, and those cars coming off lease. And they are also aware of the extension in the terms that are being given to purchases of new cars. So whereas like 48 months went to 60 months, now there's 72 months you can get a loan for. And they're saying, between that and the cars coming off lease, they're concerned with the resale value. So they're pulling back in the auto origination business. And that's being a pressure to the overall growth of the loan book. And then with respect to mortgages, housing demand continues to improve. Problem is that as rates begin to slowly tick up, you're seeing less of demand for refinancings. When rates go down persistently, that's a huge tailwind to mortgage originators like Wells Fargo because they are able to continually just churn that. So someone will come in, refinance a house, they collect a fee. Someone will come in, refinance a house, they collect a fee. When rates increase, you have the extension risk and you don't get to get that refinancing. Yeah, you can still have the mortgages on your book, but you don't get that non-interest income, which is so big for your efficiency ratio.
Yeah, and that becomes a challenge, and in some regards offsets, kind of the hyperactivity that one would hope for as housing demand uptakes. If you kind of had this perfect coalescing between some of the things we've talked about on this podcast before of housing demand increasing, first-time home buyers increasing, and you were able to add kind of that component of refinancing happening regularly, all of a sudden that's kind of a perfect storm for a company like Wells Fargo with so much mortgage exposure. But you're losing a core component of that on the refinancing side.
Yeah, and especially when you're pressured on the business in general, and you're not getting that fee growth.
Right.
That's going to be really difficult to get your efficiency ratio down. So, to me, the weak quarter wasn't surprising. Wells Fargo is a 3-year play. I mean, it's not a short-term play, and you can say, well, an investment is just a trade that goes bad. But I think this is something where you could wake up in 3 months' time and all of a sudden people think that it's over and you've seen a revaluation of the stock. So this is one where the company just continues to make very slow, almost frustratingly slow progress. But they had so many, when you have something as bad as this account scandal, there are real problems at the core of the operation. And when there are problems at the core of the operation, you have to completely retool. And that takes a lot of time. It takes new employees, it takes retraining employees, and it takes a new discipline that really takes a long time to implement.
It's a culture change.
Exactly.
You have to change the culture, because it's easy to think of, oh, well, you had however many accounts, and this is, starts at the top, and it certainly does. But then, if you live in an area where there's Wells Fargo banks, which is most places, imagine how many of those you see, and then imagine having to retrain everyone there, and reset a standard and reintroduce measures of accountability while still trying to continue to operate at an efficient level. That's a challenge.
Yeah, and I mean, we've seen it. We work at a small business, but anyone who works at a small business, if you try to change the culture of that small business, that's going to take a really long time to change, even if everyone wants to change it. Similarly, imagine how much more difficult it is for a large business. So join a small business where you get the culture, because otherwise, you're not going to be able to change it.
Looking at Wells Fargo, kind of moving ahead, we do own Wells Fargo stock. We also own JP Morgan and Citi, the other bank stocks that we were referencing this week. You continuing to hold, and if so, what are you really looking for going ahead? I mean, obviously you said it's kind of a longer play. We might see some kind of revaluation coming up, but what would trigger that, I guess?
Yeah. So what the street wants to see is an improvement in loan growth. If they can get an improvement in loan growth and an improvement in the efficiency ratio, if that efficiency ratio drops down below 60%, you're in business on Wells Fargo stock. And if that loan growth starts to accelerate to 3-4%, you're doing well too. But you need, I think, one of those fundamental changes to occur. So that's what I would say with Wells Fargo. For me right now, I think it's going to be fairly range bound, so I'm going to look to buy at the bottom end of the range, trim at the top, but continue to maintain a core position.
Mm-hmm. So there you go. Anything else to add on that?
All good. That's it.
Alrighty. So stay tuned, hit subscribe, all that good stuff. We do have a macroeconomic presentation coming up on YouTube in just a couple days. It'll be on there, youtube.com/TuskMediaLLC. We'll talk about what's going on, with the economy in the U.S. We'll also look at some global markets, and also kind of try to tie it all back into the companies that we actually own and what we're doing sector-wise, things like that. Not going to show all our cards, but kind of get in there and talk about what we're doing. That's going to be something we do quarterly. So check that out. It'll be on video and audio. The audio will probably not be the best resource because we won't have the slides going with it, but check it out nonetheless. YouTube should be up later on this week. Y'all have a great day. Talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.